Hello, everyone, and welcome to today's Energy Storage News webinar with Grid Beyond, where we'll be learning about successful trading strategies for battery storage assets in the CAISO and ERCOT markets of California and Texas. I'm Andy Colthorpe, editor of Energy Storage News and deputy editor-in-chief of publishing at Solar Media. When we began the site 10 years ago, California's then Governor Jerry Brown had already passed Assembly Bill 2514, the nation's first mandated energy storage procurement target for investor-owned utilities, but actual deployments were yet to begin. The state's major load-serving entities were ordered to deploy 1.35 gigawatts of storage by 2020, and they put contracts in place well ahead of their deadline. That almost seems quaint when you think about what happened between then and now. As of 2019, California had 770 megawatts of grid-connected batteries. Today, there are more than 13.3 gigawatts of mostly 4-hour duration battery energy storage system, or BESS, assets in the Golden State, according to recent California Energy Commission statistics. In other words, almost a tenfold ramp up from what seemed like a game-changing target in 2010 when AB 2514 was passed. Texas's ERCOT market, meanwhile, leapfrogged other early leaders like Hawaii or the PJM Interconnection Regional Transmission Organization area. It was driven forward not so much by policy like California's, but by the deregulated energy market and volatile grid for which batteries are the perfect match. Texas is now on course to hit the 10 gigawatt mark in 2025, and in the second quarter of this year, research firm Wood Mackenzie found that between them, Texas and California accounted for 60% of all grid-scale battery storage deployments in the US. These are all exciting numbers that speak to a major power market trend of energy storage adoption that is spreading across the US and the wider world. But, as with so much in life, behind the major headline figures beloved by journalists lie a much more complex set of dynamics that direct how the California Independent System Operator and Electric Reliability Council of Texas markets work. Just because both have a lot of batteries and continue to attract more and more to their interconnection queues, that does not mean that there is a new gold rush where every asset is going to earn big money. As we will hear from today's expert speakers from Grid Beyond, there are a lot of variables to consider, from changing regulations and market rules to the interplay of extreme or conversely mild weather and peaks in electricity demand and therefore price volatility spreads. In this session, Ali and Alden from Grid Beyond will give you a deep dive into those all-important trading strategies that can maximize revenues and mitigate the risks of cycling BESS assets in the US's two leading markets. So our speakers today are Ali Karimian, Market Optimization Director at Grid Beyond, and Alden Finney, who's Grid Beyond's Sales Director. As always, interaction with you, the audience, is really important to us. Our speakers' presentations will be followed by a Q&A session, so please put your questions into the questions tab that you can see on the right-hand side of your screen. We'll try and tackle as many as we can in the time allotted, but rest assured that Grid Beyond will reach out and contact you so that you can ask those questions and continue the conversation offline in the coming days for the questions we don't have time for. And finally, from me, today's session is being recorded and will be available to view on demand at the Energy Storage News website within a few days of broadcast, and presentation slides will also be sent to registrants. So with that, and without further ado, it's my great pleasure to hand over to Ali and Alden. I think Alden's going first. Over to you guys.
Great. Thanks, Andy, and thanks Energy Storage News for hosting us. We're excited to be here and excited to continue our partnership on multiple fronts. I'll introduce myself first. Alden Finney, I'm the sales director here at Grid Beyond. I've been with the company about 3.5 years. Before Grid Beyond, I worked in energy and sustainability software. Was on the energy markets team at an LX, and have a background in flexible resources for the energy transition. my colleague Ali is joining us to really be the brains behind the operations here. Ali, you want to give a quick intro to yourself?
Happily, very happy to be part of Grid Beyond. I joined Grid Beyond a year ago from a company called Key Capture Energy. Over there, I was the director of market operation. And before that, I was at Constellation. Before that, I was at KKR, a private equity company. And before that, I had 2 graduate schools, a PhD and a business school. Very happy to be here.
Thanks, Ali. Ali's based out of Baltimore. I'm out of New York City myself. We'd love to see you in person if you're ever in those areas. We're also going to be traveling around the country, or at least into the major markets that we're talking about today. We're going to be in San Diego next week for the Battery Asset Management Summit. We're going to be back in San Diego for Intersolar in February, and then we're going to be in Dallas, Texas for Energy Storage USA, a great conference in its 7th year in March. And if you like what you hear today, if you want to dig more into some of the regulatory questions as well impacting energy storage, especially in the ERCOT market, I'd encourage you to check out our webinar, which is available on demand from earlier this year. I'll give a quick background to Grid Beyond. Grid Beyond got started in 2010 in the European energy markets. We're headquartered out of Dublin, Ireland, and have a global presence around the US, Australia, and Japan, as well as the British Isles. Our US headquarters is in Austin, Texas, and we cover ERCOT, CAISO, PJM, MISO, SPP, soon to be ISO New England and NISO as well, and have projects with utilities in some of the vertically integrated territories focused on battery storage and solar. Really excited that we raised a Series C investment round earlier this year. With backing from Constellation, Energy Impact Partners, ABB, a lot of other great partners around the world. And what I think that these folks saw in Grid Beyond was a data science toolkit to tackle flexible resources for the energy transition. So we work with about 1.3 gigawatts of batteries worldwide. We also work with 2.3 gigawatts of load. So a lot of that's enrolled in demand response programs across US and global markets, supported by 160 people, both in the US and abroad. So we're really excited today to talk about 2 of the major US markets where we work with battery storage assets. Those will be ERCOT and CAISO. And we've seen a lot of changes in the past couple months in ERCOT especially. We've seen saturation from ancillary services impacting revenues of battery storage assets, as well as behind the meter resources that we work with really heavily. And I think that this has been a long time coming, but has actually materialized in the last 6 months. Ellie, do you want to talk about some of the market dynamics that we're seeing in ERCOT and CAISO?
Sounds great. So what happened 2024? Over here, we have 2 graphs. On the left side, both of them are, by the way, neither of them are real assets. We don't show real assets in this graph. We have a backcast of a 2-hour duration battery, and everything is normalized. So both batteries are 2-hour duration. The one in ERCOT is simulated for settlement point at West Hub, and one in CAISO at SP15, Southern California. Let's look at them. In both of the cases, the dashed lines are the revenue, dollar per kW month, so normalized by the capacity of the battery in 2023. And 2024 numbers are solid lines. We can see for ERCOT that revenues are somewhere in the range of 5% to 10% of where they were last year, especially in high earning months. And in CAISO, although they're generally lower, they're not that lower. Like they're, and we're going to talk about this. Like for the rest of this conversation, for a few slides, we're going to have a deep dive into what happened. Like what happened specifically in ERCOT. Was it all because of weather? That's something a lot of people talk about. Like they keep saying that weather this year in ERCOT was mild, like which is true. And that's not all the picture. Like there are other factors that have been really important that not many people talk about. Before I leave this slide, one thing that we've noticed for people that have been using our software alongside other people that provide bid optimization, that we have outperformed some of our competitors by 50% during like the very heat of the market in ERCOT. And it just shows to me how much it matters to have a good optimizer. If you don't have a good optimizer, Like not every optimizer is the same. There are so many, there's always devils in details. And we will talk about some of those details in this presentation. So, realized prices. Before we even have a deep dive into the drivers of changes, let's talk about how prices printed this year compared to last year. Again, on the left side, so y-axis in both of them are dollar per megawatt hour of prices. Left side ERCOT, right side CAISO. The blue lines for both of them are energy prices. The red lines for both of them are the reliability service. That's equivalent in both ERCOT and CAISO. And ERCOT is RRS, and CAISO is SPIN. They are very similar services for what batteries provide. So it's a fair assessment, in my opinion, to compare RRS pricing with ECRS pricing, ERCOT and CAISO. You can see that last year compared to this year, they had energy prices at West Hub. They have come down, especially in summertime. But what is very notable to me is that RRS prices have been crushed. You can see in the tables that, like, for example, in August, let's just look at August, because that was the highest price last year. They had prices were $260 to $40. Sure, there's a big drop, like 1/8 almost. RRS was $30 to $2. That's a factor of 1/15. That's a huge drop. Sorry, it was 120 to 8, 1/12 almost. That's a huge drop anyway. Whereas in California, there was a drop. Some months quarter, some months less than that or more than that, but it's not as significant as ERCOT. So what happened in ERCOT? The most obvious ones are installation of batteries, installation of new solar, and weather being milder. But those are obvious, everybody talks about them. Before going to the next slides, let's have a little bit of look at them. Again, two sides, ERCOT and CAISO. What we have plotted in here is net load and net and load. So load is demand, right, at the ISO level. And then for ERCOT, we are showing the net demand, which we call as demand minus solar generation minus wind generation. And why that's important is that wind and solar, like, they provide producers, a lot of times they're price takers. They just provide their capacity at zero price. Because of that, or even sometimes they're even able to, they even sell at negative prices because of ITC and PTC, production tax credit. So because of that, net demand is the actual amount of demand that all renewable, like non-renewable capacity is fighting for, or they want to provide. If you look at the net demand of like this year compared to last year in ERCOT, that's a red line. It's been somewhat lower this year compared to last year, which is, everybody again talks about that. But interestingly, once you add up outage of this year compared to last year, they are very comparable. And that's the part to me that makes it sound as if, okay, if net load plus outage, which is like the amount that needs to be served by capacity that is not on outage, if there's no difference to last year, then what happened? Why is it that prices dropped so much? And on the right side, similar story before we go to the next page. At CAISO, net demand of this year and last year were comparable. And there has been a lot of solar generation capacity added in both CAISO and ERCOT. And that's, you can see them in the bottom graphs, that wind has been similar to last year, almost. But solar, in both of the ISOs, there has been a major jump in how much solar has been added. Now, this is the fun part. So one of the major problems that, I don't want to call it a problem, one of the major changes that happened in ERCOT last year was the introduction of ECRS. And what happened with ECRS was that at the very beginning, ERCOT, it took them a while to figure out how to dispatch it to the grid. So what happened, so if you are a provider of RRS or ECRS in ERCOT, the reliability services, ERCOT will hold back the procured megawatts. Let's say that they have procured like 5 gigawatts of reliability. They're going to hold it back from dispatching in the real-time energy market. Of course, like there are some details that they can be added back to SCID, to energy market. Let's not talk about that right now. So the ERCOT holds back that capacity from being in the energy market. So what happened last year was that all of a sudden, all of the capacity that was providing RRS and ECRS was not participating in real-time energy market. And ERCOT always has this measure they call operation reserve. It's a difference of what is the capacity that's available to provide electricity if they are called compared to demand. Like the gap is how many more megawatts of generation is available if they are needed. And as more of that capacity was allocated to ECRS, that whole chunk was subtracted from operation reserve. So what happened was that because of that, ERCOT and how SCID is how ERCOT runs real-time energy market. They have been showing very high prices for almost all summer, many intervals with $5,000 per megawatt hour prices in real time. And when real-time prices go up, day-ahead prices go up. And when day-ahead price of energy goes up, ancillary prices go up, because there's always a dance between ancillary services and energy. Like if you're providing one, you can't provide the other one. So there's always opportunity cost. If day-ahead energy cost goes up, the head of ancillary should also go up so that people will provide ancillary services. But as this year, ERCOT had a better grasp on how they're going to dispatch resources that have ECRS obligations. There was a whole NPRR called 1224 that went back and forth between Texas Public Utility Commission and ERCOT at the end, and it was all about how ECRS resources get dispatched in real time if needed. That is at this point scrapped, but it definitely is going to come back. And it doesn't mean that ERCOT doesn't dispatch resources that have ECRS, carry ECRS into real-time energy. It just means that there currently is no defined algorithm for it. ERCOT has been dispatching more ECRS. As a result of that, energy prices have come down. And as a result of that, when real time come down, again, as we said, day-ahead energy comes down, ancillary prices come down, everybody, like market is just calmer. One other interesting difference of this year compared to last year is this concept called ROC, Reliability Unit Commitment. That's a process that ERCOT runs. So how ERCOT works, ERCOT energy market, is that they procure the day-ahead market. And day-ahead market, everything is about supply and demand. They like suppliers, the generators provide their curves. This is the price that we're going to provide our megawatts. And load says that this is the price that we're going to buy. There's a point that they intersect. That's where the price of day-ahead energy is set. However, that's not the end of the story. When it comes to real-time, ERCOT needs to make sure that enough megawatts of generation are available, even if they were not called in, even if they didn't clear or participate in the day-ahead energy market. That's where ROC comes in, Reliability Unit Commitment. And this year, ERCOT started adding more aggressiveness to how they called ROC to make sure that the grid is stable. And as a result of that, real-time energy prices have generally even become more suppressed. So thinking of it for going forward also, higher installation of batteries, that definitely will put more pressure on prices down. Deployment of ECRS into SCID in ERCOT, definitely downward pressure. More ROC deployment, downward pressure. But that's not the end of the story. The good news is that there are a few very interesting points that will keep the prices higher, especially in hours that batteries can participate in. Most likely you have heard about the duck curve. The duck curve is like we talked about the net demand, like the difference of demand and solar and wind generation. During nighttime, you have a lot of wind generation. Generally, during daytime, you have solar. And as you know, early morning and early evening are where like there are almost dead zones that solar is not much there, wind is low. And that's when the format of a duck is created. And year after year, that duck curve has been getting deeper and deeper in California. And in ERCOT, we have also a duck curve in ERCOT right now. That's something that people didn't see happening anytime soon, but it's here. Why is that important? The reason is that Alden, do you want to have do you have a point that you want to make?
At some point, we're getting a question on the duck curve. So maybe as you're talking about it here, I'll pose it to you. Alex Schulman asked, what's the reason for the duck curve getting deeper? But I think you're about to get to that for the ERCOT duck curve.
Yeah, that's because there's a lot more of solar and wind getting installed. And behind the meter and front of the meter, the net load that shows up to the grid just during the day is getting lower and lower. Whereas in the early morning and early evening, there's not much impact from solar and wind. And why that gets really interesting is that as this duck curve gets deeper and deeper, there are going to be two narrow bumps, early morning, early evening. And the narrow bump can happen only for 1 hour to 2 hours. And why that's really important is that for gas and thermal resources, or even gas peakers, it's almost poison. If you end up running your power plants, even at gas, so gas peakers are essentially like jet engines that they run really quickly. They can ramp up and down in theory. But if you keep running your gas peaker twice a day, 2 hours in the morning, 1 hour in the morning, 1 hour in the evening, they break down frequently, which means that their maintenance will become more of a hassle. So as duck curve is getting deeper and deeper, that's an area that is just shouts batteries. Like batteries need to serve that, because batteries are really fast. They can serve 1 or 2 hours and just recharge again. And as load also, especially in ERCOT, has been growing massively. Like there are a lot of more crypto miners, AI servers, data centers that are installed in ERCOT. They are pushing load higher and higher. And last but not least, there are these old power plants, specifically coal power plants, that are old technology. And as they're getting retired, people don't want to bring back coal. At this point, people are trying to install more gas in Texas Energy Fund, but nobody's putting their money into bringing coal assets back. And that's a base load generation that once retired, it has to be substituted by either gas or batteries.
And maybe one more point here, as we're talking about a lot of the dynamics in ERCOT and their comparison to CAISO. We're starting to see how batteries trade in ERCOT look a lot more like how batteries have traded in CAISO, and that's, you know, satisfying some of these short duration energy peaks, doing a lot of day ahead and real-time trading, which we'll talk about later on, but having to rely less on the ancillary services markets that have been really, you know, bountiful for energy storage in ERCOT traditionally. So a lot of what we're seeing is really reflecting the maturity of energy storage in ERCOT. The saturation, the price collapse, you know, in some ways reflects the success story that you can see of, you know, the amount of megawatts installed of front of the meter batteries. And, you know, by the end of the year, I think there's, you know, a lot of anticipation that ERCOT will actually surpass CAISO in the amount of front of the meter batteries installed. And you can see the, you know, sort of astronomical growth that we've seen since earlier this year here. And that's, I think, really the story of, you know, batteries in ERCOT are going to have to rely less on the ancillary services. They're going to have to trade more wholesale energy. And that's really one of the areas that we focus on with our customers.
Thanks, Alden. Very briefly, like revenue optimization, the CAISO versus ERCOT, there are some subtle differences. The concept is the same. At the end, you have revenue that the battery makes. That revenue comes from energy market, ancillary market. In CAISO, they also have ROC payments that are different from the way they happen in ERCOT, and what they call bid cost recovery and few ancillary services that are procured in real time. Revenues that we can optimize over are essentially energy and ancillary services. We have the whole slide over here, and if you're interested to talk more about it later, you can reach out to us. Like there's a lot that goes into how to properly model this revenue in the bid optimizer. And our bid optimizer has 15,000 lines of code, just to give you a sense of the complexity of modeling all the regulations and the nuances that are part of the bid optimizer. In the next few slides, I want to go over how we have offered two batteries, one in ERCOT and one in CAISO. The first one is in ERCOT on August 20th. That was a day that prices went up. That was, in fact, the only day this summer that prices went up to $5,000. And it was really important to have this good prediction that real-time prices will spike more than how other prices will. And we had a good prediction of that. And as a result of that, you can see in the bottom left corner, that is how we have offered different ancillary services. And around the evening ramp time, you can see that we didn't offer ancillary services at all, or offered very little after that, so you don't have to charge the battery after that. And batteries kept discharging in all of the very expensive hours of 18 to 19 at that point. So in CAISO, two examples. One of them is from July 8th. Very interesting story that over there, ancillary service market has day-ahead and real-time component. The real-time reg up spiked way more than the day-ahead other ancillary services. And that's a really hard one to predict because real-time ancillaries in CAISO generally clear at zero. So if you can somehow have a good prediction that the real-time ancillary service is going to have a spike, you're going to hold back that capacity from day-ahead services, and that's what we did. And in all that hour that the battery spiked, we had no day-ahead obligation, and we could offer the real-time ancillary service and have a really good P&L on that day. July 24th was another day that real-time energy prices had a major spike. That's the plot on the bottom right. And the plot on top right, that shows the allocation of ancillary services that we had in day-ahead and real-time. And as you can see, the capacity in the hour that we predicted there would be real-time spike was not offered to ancillary services in the day ahead. So we had all that open capacity to offer the battery in real-time energy market and, again, have a really good P&L on that day. So we talked about all of the strategy that essentially we had so far. The question is, now that, as Alden said, there's more and more emphasis in ERCOT on the energy market relative to ancillary services. Like, what are the areas that have to be changed or have to improve so that you can improve the P&L? One of them is that in ERCOT, so far, day-ahead energy was not a big component. Of course, like, traders placed day-ahead energy bids and offers and hours that they thought, but it was never like a big money maker. Let me rephrase that. Not never, I'm sure there are really good traders that this has always been their thesis. This was not a common thesis that a battery is going to make money in the day-ahead market. So for us, that this year we decided to include the day-ahead energy market into our strategy. We spent a lot of time on that, both on the forecasting side and on the programming side. And in the past month and a half that the strategy has been active for us, it has made a positive 20%, 23% P&L relative to the strategy that didn't contain day-ahead energy. Another topic that's getting very important for us is we have partnership with a major OEM that we're working together side by side on integrating our bid optimizer with how they provide diagnostics for their hardware. So the idea is that the hardware has a lot of wear and tear, or they just break during an operating day. If your bid optimizer can have a good sense of what the hardware is going through and how it will react to the bids and offers, we adjust them. And that's the joint project that we are currently working on. We're very excited about this. And whenever it's unveiled, I'm pretty sure we'll talk to you guys more about it. And real-time offer curves is another one that we can talk more about it in detail if you are interested.
Great. We got a great question in here on how were we able to predict that real-time price spike? And I think that the bedrock of any successful bid optimization is correctly predicting the prices. Every model is wrong. Ours are very useful. And with that, we look at forecasting energy pricing, ancillary services pricing. We very critically look at forecasting the deployment ratio of ancillary services. So we have an idea of the energy throughput that a ancillary services position will have in the battery, and we can calculate sort of future anticipated state of charge to top up with any additional offers that we can put in there from there. And we always, sort of do this in the context, obviously, of the physical constraints of the battery, the cycle limits, the warranty condition, and often work with our clients on sort of strategies that make the most sense for how they're using their assets. But I wanted to dive a little bit deeper on the forecasting because I do think it is such an important component here. We have a team of 35 data scientists and software engineers who work on optimization, but also in-house forecasting of power markets across the country and around the world. And we leverage machine learning, but also other data science tools to pull together probabilistic forecasts of power price outturns. You can see some of the sort of training data sets that we have here. And we look generally at around 100 factors per market. We pull these in, we run these through machine learning algorithms. We use classifier approaches to determine which model best explains the market behavior that we've seen recently. And we dynamically swap in and out those forecasting models so that our optimizer is really operating with the best possible information every 5 minutes in the real-time markets, every hour in the day ahead in ancillary services markets. So we spend a ton of time on forecasting. We license the forecasting suite as well, some major trading shops. So to the extent that you want to talk about forecasting and how we could hopefully squeeze some more juice out of the assets you're working with, whether those are batteries, whether those are thermal assets, whether those are flexible load assets, happy to talk more about forecasting because I think it is such an important component of what we do here and can feed up into the optimizer itself.
Alden, with all the detail, I have a feeling you work on a data science team.
I just play one on TV. Ellie, I know you are realistically closer to this than I am. Do you want to talk about some of the forecasting accuracy metrics that we tracked from over the summer?
Absolutely. So over the summer, August was 1 month that we chose for this presentation. It's representative of all of our 2024, in fact, performance. Again, the top graph, and this is just two because there's too much information to show. Again, they are just representative. We are showing day-ahead energy, actual versus forecasting, one at SPP and one at West Hub. Shaped MAPE is what we call, is one of the measures that we use for tracking accuracy. And the reason is, and essentially giving more weight to peak hours. So both of them, we can see that prices realized versus forecast have been tracking each other very closely. And people keep asking us about what projects, after the collapse of the market, what projects are going to stay valuable in ERCOT. It's really hard to say exactly which projects because you always need to have a deep dive into the node to have a sense of how the congestion is going to play out in the next few years. But these are a few large, let's say, categories that we were thinking of. On the small side, so small batteries in ERCOT are DGRs, 9.9 mix, and large batteries are generally 100 megawatt plus. For large batteries, they're cheaper to build per megawatt, and they are more efficient to maintain. On the plus side of small batteries, you can find land more easily close to the areas that you care about. And the other one is that there are penalties that ERCOT imposes if you can't follow ERCOT's commands called base point more closely. And those penalties are way lower for small batteries just because the size of battery is small and it goes under the radar of ERCOT's threshold. For long-term value of the projects, we definitely believe that there's going to be a lot of value in intraday energy trading, as Alden said earlier. So role of forecasting is going to be huge. And you also need reliable hardware. There are so many providers of services that their hardware is really not good, and we have seen all of it. We've seen hardwares that break down often. We've seen hardware that have been relatively reliable. Reliable hardware really goes a long way.
And the last piece that I think we feel really strongly about is having a good optimization and trading team. We offer that as a service, as you might have anticipated, via our trading as a service. We also license the bid optimization software itself, if you prefer to sort of self-trade these assets, but utilize some of our data science toolkit. And we also provide a suite of services around EMS, demand response and VPPs, long-term revenue consulting to the extent that you're looking at investment in assets, and the short-term nodal forecasting suite that I mentioned as well. So happy to talk about any of these offline, and hope to see some of you in the future. Wanted to maybe quickly highlight what we're doing across various markets. We have active assets, ERCOT, CAISO, as well as around the world, Japan, Ireland, UK, and Australia. Building out currently our battery optimizer, at least for PJM, where we're already participating with about 100 megawatts of behind the meter load. And next year we'll be going into NISO and ISO New England as well with some partners of ours. So we're excited to see where each of these markets go. We'd love to talk with you more about projects that you're working on and see if there's a way to earn more money in these merchant markets together. So with that, I know we have a few questions coming in. Here's our contact info. We'd love to talk to you offline. Love to leave you with a few key takeaways from the P&L, but I'll hand it back to Andy for the Q&A portion here.
That's terrific. Thanks so much, guys. And yeah, really information-packed session there, and lots of great questions coming in. And as I mentioned before, we're not going to have time, obviously, to answer all of these questions. I think some of them probably a bit too detailed. Yeah, even if we had another half an hour, probably to go into them. But I do know that the team from Grid Beyond are more than happy to follow up and answer these and take the conversations offline. We'll also keep Ali and Alden's contact details up there on the screen now, shall we, while we do the Q&A session. Yeah, so a few questions from the audience then. And so Gerardo, hi Gerardo, good to hear from you. Former webinar participant himself, actually. Gerardo asks, how interesting are the grid services markets in ERCOT? Which ones allow for that high return on investment for battery storage?
And we may have covered part of this already on the sort of shifting, pricing and the trends there around ancillary services saturation. I assume, grid services is referring to ancillary services here primarily. Realistically, we're still looking at RRS, ECRS, non-spin to the extent that you have a longer duration asset, as well as reg up and reg down for ancillary services. But I think the real thesis of what we've seen over the last few months has been that you need to focus on the energy side, definitely real time, looking at DART trading as well now to complement the grid services revenues that sort of previously would have allowed for a high return on investment. We just think that the market has sort of fundamentally changed here, given the amount of batteries that have come online in ERCOT in the past 6 months.
Sure. Anything to add from you there on that, Ali, before we move on?
All good. Alden is an expert.
Alden summed it up beautifully. Okay, no problem at all. So a little bit of a different tack for this question, but I think it's an interesting one to ask. So Alex asks, so thanks very much for your question, Alex. Do you consider the effect of growing adoption of behind the meter batteries and virtual power plants on front of the meter energy storage pricing? And I guess there's a bit of a dynamic between distributed storage and front of the meter, but yeah, how is that something you factor into how you guys look at markets?
A really good question, Alex. So there are two parts, like energy and ancillary services, and they're very much separate because VPPs as of now, so there's this order FERC 2222, as you're most likely aware of, that everything will come to wholesale market, but right now we're not there. As of now, VPPs, the only way that they can provide ancillary services is via demand response. And demand response is a sliver of all ancillaries that can be provided. For RRS, I believe it's around 1/4 of all procurements, and in ECRS, it's half. So on the ECRS side, it's larger, way larger. So VPPs definitely will eat in like the share of the pie for ancillary services. And behind the meter batteries also, like they will most likely, they can also participate in demand response depending on the size of the battery. So ancillary, one more reason that ancillary market will just come lower and lower, as there are these resources that are behind the meter that will compete for providing the same ancillary resources. But energy is going to be different. For energy, definitely VPPs and behind the meter have some capacity to also make up for a difference, depending on how FERC 2222 goes. Let's go back to behind the meter batteries and VPPs. Neither of them can inject power to the grid. They can only subtract load. And with especially morning ramp, like a lot of times for households, especially, like what you care about is injecting power. If you can inject power, like that's what the front of the meter battery can do. Of course, slashing load is also very important. But as long as we don't have FERC 2222 in place, I don't think if the effect is going to be that massive on the energy market side.
Okay.
Nothing to add.
No problem, no problem. Thought I'd give you the moment anyway, just in case. And then, so yeah, there's a couple of questions, well, lots of questions, let's be honest, on optimization. And Pal asks, thanks very much for your question, Pal. In terms of optimization, you showed days where most of the revenue share comes from a specific event. Mm-hmm. I'd like to know how you would approach optimization of a more mild ads where risk can be more linked to activation volume, including things like state of charge.
Yeah. Good question.
Great question. And maybe, Ali, I'll let you answer that. Maybe I'll throw in, I saw another question from Marcus that's sort of related around prediction models for future SOC. Maybe, if we can combine the two and talk about sort of prediction of SOC and sort of how we use that as one of the metrics to increase uplift, especially on those mild days.
Oh, that's
sure.
Really
okay, well, do you want to go through Pal's question, and I'll read out Marcus's full question after that?
I think we can answer both of them together, as Alden was thinking about. So all goes back to forecast of prices, forecast of deployments. Even if it's a mild day, how mild is a mild day? Is a mild day a day that the prices are even clear under $1 or under $2 for ancillary services? If that's yes, most likely we will not even offer ancillary services, because if an asset breaks down, it's more of a hassle to procure the ancillary services that now you have to find somebody else to fulfill the obligation on your behalf. But then let's say a mild day that prices are more than $2, but still not $100, right? It all goes back to SOC management. Like you have to have really good sense on how different ancillaries will be deployed throughout the day, so that with the cycle count limit that you have, you can go through your day, make the most money that you can, and your SOC and cycle count stay in the limit that you want. And just to add this, that for us, there really is not, like our optimizer is not regime dependent. It's not like the optimizer, we have a different optimizer for a mild day versus for a volatile day. It's the same optimizer. The limits that the constraints that are part of the optimizer that will limit how the SOC will move throughout the day and the cycle count, at the end, those make a huge difference in how we allocate the megawatts to different services. Okay,
sure. And if I could just recap Marcus's question just for the benefit of the audience. Marcus says that you mentioned using battery models to predict metrics like future state of charge. So you did allude to that briefly just there, but can you elaborate on how state of charge and other factors, such as battery aging, contribute to improving the accuracy of your forecast model?
Absolutely. So predicting future SOC goes back to having a good forecast for how ancillary services that the battery is providing are going to be deployed and at what hours energy is going to be discharged or charged. And there's a really good question about the impact of battery aging on SOC. Our optimizer itself is age, I don't want to say naive, but age independent. But it does have a constant communication with the EMS, and EMS is one that will provide, say that, hey, this is the band, that this is the current SOC, and these are like the amount of available energy. All of those health-related variables that impact the optimizer will come through the EMS that the optimizer will use. I wish we could have a dialogue conversation to make sure if there's something more that they wanted to talk through.
Okay, well, I mean, it's something I guess you can continue offline. And if maybe it's worth sharing with the wider audience, get in touch with me, and perhaps it's something we can talk about on Energy Storage News. So yeah, just one last question I think we've got time for. We've overrun a little bit, but I think everyone's that stayed on kind of deserves as much of a chance to get their question answered, so let's do that. So Ajit asks, and thank you very much for your question, Ajit. Do you think AS prices, I assume that to mean ancillary services prices, have permanently saturated in ERCOT? And what do you think would need to happen to see an uplift in AS prices in 2025?
Well, we know Ajit, he's a very smart person, I'm pretty sure. Like he is well aware that there is no perfect answer over here. Like if it's a summer or winter with a huge storm or huge heat wave, that definitely will make a huge difference. This summer we didn't have that. Or who knows, maybe there would be a summer that for some reason there would be a lot of outages that batteries have to make up for the difference. Because outages a lot of times are unforced, meaning that they just happen. Nobody can predict them, they happen, and if they happen, it's a great opportunity for batteries to make that money. When it comes to saturation of AS, at this point, unless they increase the procurement size, I don't see any reason why. I don't see any reason how we can avoid saturation at this point. Again, unless they increase the size that they need to procure for different ancillary services.
Maybe to piggyback on that a little, we, over the long term, right, there's sort of two countervailing trends that I think are going to impact ancillary services price saturation in ERCOT. You have the explosive growth in renewables and you have the explosive growth in battery storage. And so, a sort of change in either of those growth rates could lead to, as Ali said, a difference in the amount of ancillary services that could need to be procured, at least on the renewable side, right? If you have sort of non-controllable generation replacing controllable generation, that could lead to some, sort of medium-term shift in the amount of ancillary services that need to be procured. And then maybe the question is how many batteries are continuing to come online, such that everyone's fighting for that sort of, same share of a pie that is probably less dynamic than the amount of batteries that are coming online. So probably not permanent. I think there's, two sort of mega trends going on here. The other piece that I'll just add that we're tracking, right, is behind the meter assets participation in ancillary services markets. We work with folks like crypto miners right now who are great assets participating in RRS or ECRS or NSRS. And so I think that there's, right, if something fundamentally changes in, crypto mining, that could also impact ancillary services just because there are, there's such a supply of very flexible behind the meter resources that are now on the grid. And, if conditions were different, either larger economic conditions or, sort of specific, how behind the meter loads participate in ERCOT conditions, that could, I think, also sort of swing the needle on ancillary services saturation.
Excellent. Well, guys, thank you so much for the benefit of your expertise and insights and experience in both of these really important markets. It's been a real pleasure working with both of you and your team to put together this webinar. So yeah, thanks a lot. It's been a real schooling for me as well. I think. So yeah, so thanks so much, Alden, and thank you, Ali. I guess
Thank you,
probably the
Andy.
biggest thanks. Yeah, no problem. You're welcome. And I think the biggest thank you has to be reserved for our audience today. So everyone, thanks so much for signing up in great numbers, and to all of you watching this in future on demand. Yeah, I just want to say it's a fantastic industry to be reporting on. Really enjoy these conversations and the depth of insight that we get. It's a brilliant industry to be part of, and just to end on a positive message, keep on keeping on. I think it's a really great time to be involved in clean energy and energy storage. So yeah, thanks once again from all of us here at Energy Storage News and on the stage with Look Beyond.